I'm joined now by Ralph Silva. He's director and analyst at Silva Research Network. Ralph, good to see you.
Right.
So just take us through exactly what the Basel deal means for the banks.
Well, it means that banking in general is going to be less profitable because they have to keep more money. Now, ironically, most of the large banks in the G20 countries already subscribe to these rules, so they're probably going to fulfill this quite easily. The difference is that they were planning on using the extra money to make profit, and now they're going to have to rejig their profit estimates because they're going to have less money to actually put into the marketplace. It's going to be safer, but less profitable.
It's going to affect different banks in different ways, right? But I suppose the immediate focus will be on the banks that are most fragile right now.
That's right, the systemically important banks, which happen to be the larger organizations, which incidentally are going to be harder hit by Basel III than these smaller banks. But again, the irony is that these large banks already have these funds in place because the national governments have insisted that the local banks do it. So this isn't going to be a huge leap forward for them.
So if we just do a bit of a breakdown now, how's this going to affect French and German banks in Europe?
I think generally Western European banks are probably already there, with the exception of German banks, the small German banks. And again, it's the U.S. that's going to have another problem because the U.S. is predominantly small to medium-sized banks, just like it is in Germany. And those two countries are going to have the hardest time because the small to medium-sized banks are certainly nowhere near that capital area. Now, there are a few big banks in Germany that also need capital, Deutsche Bank being one of them. And it's going to be the early bird that gets that money. So we're going to see a huge run at new capital from these organizations because there's not that much money out there.
So we're going to see more banks following in Deutsche Bank's footsteps, you could say.
We have to, because some of the larger banks that need some money, it's not a lot of money that they need. There's just not that many investors out there willing to give money to banks these days. So you want to be first.
It's interesting you say that. European banks, though, did manage to raise, what, $20.5 billion last week. So that was pretty good for them. Fastest rate of borrowing, I think, in almost 6 months. Will that renewed investor appetite continue, given the concerns?
The market's changed a little bit because when investing in banks, you had these profit expectations, but with Basel III, those profit expectations have to be reduced. So the appetite for investment within banks should be reduced as well. It doesn't mean there's not appetite out there. There certainly is. It's just not as much as it was 2 or 3 weeks ago.
And how are U.S. banks going to fare in comparison to European banks?
First, we're not sure that the U.S. is going to implement Basel III in its entirety. Basel II, they implemented only for a few large banks and not for the small banks, so they made a choice there. So we're not sure they're going to implement the whole thing. If they do, the smaller banks will, of course, suffer. So we're going to see a lot of consolidation in the U.S. Banks, the smaller banks, are going to have to get together just to meet these capital adequacy limits. So we're going to see consolidation there. But in the U.S. market, that's probably a very good thing.
Okay, Ralph Silva, thanks very much.